Hey, what's going on, church management professionals? This is Chris Charles with Spreadsheets for Business. Back again with another strategic planning video. This time, however, we've moved on from the soft skills, as I referred to them. Check out the previous videos about mission statement, SWOT analysis, and strategy formulation. The whole reason I made those videos was kind of as a build-up or to provide context for my spreadsheet videos related to church strategic planning, and this is the first one of those, and this one is on capital budgeting. Okay, expect the operating budget and the financial budget videos to follow sometime in the hopefully not too distant future. Anyhow, let me point out first and foremost that there will be a link to the post related to capital budgeting down in the description, and I also like to put shortcuts down there because, you know, as I've made these videos, and this is my first time during YouTube, I've noticed that once you get me started, it can be tough to get me to stop. So I'll talk for quite a while. This will probably be a pretty long video in and of itself, especially by YouTube standards. So anyhow, as a convenience for the people who watch my videos, I put the shortcuts down there so you can jump around as you see fit. You know, I understand not everybody has 45 minutes, an hour, hour 15, hour and a half, or whatever to sit and watch my videos. So no offense taken, you know. Check out one part, come back, check out another part, you know, do what works for you. So, capital budgeting. What is capital budgeting? Okay, well, it's different from normal budgeting. What people would normally think of when they think of budgeting, and that is they think of revenue in and expenses out, and how much you expect to have in a profit or a loss or whatever, and that is the operating budget. Okay, that'll be the next video related to church strategic planning. Capital budgeting is where you assign values to projects and then therefore with that information prioritize projects, okay, based off of the expected future cash inflows and cash outflows. So let's see, I'm reading my notes here, so bear with me. I'm trying to do less pauses as I go on and make more videos. Anyhow, so, you know, there's, particularly with a non-profit organization such as a church, there's only so much in funds to go around, and there's probably a lot of projects that you would do, okay, or would like to get involved in, but you know, and let me stop right there. A project is going to be something that would be basically last for longer than a year. It's a long-term sort of thing. It's not a what do you want to call it? Building a shed out behind the church over the weekend. You know, that's a project by, you know, by the loosest use of the term, but for the purposes of strategic planning, a project is you know, something that will either cost money and or bring in money, hopefully, over the long term. Obviously, not-for-profit organizations like a church are a little different in that their purpose is a little different than a for-profit company. We'll get in that here in just a second. So anyhow, capital budgeting is where you basically, you know, think through, forecast, as in assign figures to, money in, money out, to each of these projects, and the end result is that it spits out certain figures, these here, and those figures will should help you prioritize the project, especially when you qualify each particular project, but we will get into all of that here before too long. So Anyhow, let's talk about the difference between capital budgeting for a church or nonprofit organization versus a for-profit business. Capital budgeting was designed for for-profit businesses, and therefore projects are judged more or less solely on their quantitative aspects. Like I said, the calculations that we'll look at in the summary here: net present value, internal rate of return, etc., etc. Okay, so part of the reason I chose to focus on churches specifically and nonprofit generally for the strategic planning posts on my website is because I wanted to expose myself, to a little different way of thinking, and all of my education and experience revolves around for-profit businesses, and I thought it would be a good challenge to think of things from a different perspective, from a perspective where money isn't the sole driving force. Obviously, churches are no different from any other entity in this world that, they ultimately need at least as much money coming in as is going out. They don't necessarily need a profit, but, a little bit of a profit's ideal, opens up opportunities and everything. But you think about the types of projects that a church might have. They might revolve around things that tie into the mission, but not necessarily bring in a dime, or it might tie in to bring in more members, which in turn should bring in more in contributions and revenue. But anyhow, that doesn't mean that capital budgeting isn't applicable. Okay, it just means you got to look at it, go about it in a different way. Okay, so the thing to keep in mind now, the example I'm going to use here is basically revolves around finances, more or less. Okay, so I don't mean to say one thing and do another. It was just the best example that I could think to provide. But the situation is this: if you have a project that provides a benefit besides a monetary one, okay, whether it be to the church, whether it be to your congregation, whether it be to the public at large, whether it be to individuals on the other side of the world, okay, that's fine. You still want to be able to compare those projects because they'll all cost money. Okay, it's a matter of and time and effort, and time's more valuable than money, of course, and so they'll all cost something. But what they bring in, like I said, monetarily might be it might be a greater good beyond money, the inflow side of things. So you still want to be able to compare them because there's only so many resources to commit, time, money, etc. So what you'll have to do, and this could be tough, granted, is you'll have to, with projects of that sort, basically you got to quantify it somehow. And if you're talking things about like giving vaccines and providing water for some village somewhere, or anything else that might literally save a life, that might make you cringe, the thought of assigning a value to that. And that's completely fair. That's a completely valid way to think. But you're ultimately going to have to do it, okay? And put a value of $1 trillion on a life. I mean, if you want, whatever makes sense to you, because you're going to have to compare these projects, like I said. And if you don't have something quantifiable, if you don't have numbers tied to it, it's just going to be impossible to compare them. So, that's a little bit, like I said, on the sort of projects that might transcend dollars and cents, and a little bit of food for thought there in terms of if you go through you can still go through the steps of doing this capital budget, but just, I wanted to touch on that before we really got into it, that the kind of mindset or some things you might think about for projects like that before you get involved. So, okay. So, talk about here how to make a capital budget. Big goals require big projects. Before this, hopefully, if you've loosely followed the steps that I've talked about in the videos and posts regarding strategic planning, or somewhere else, because there's no shortage of individuals that cover this sort of stuff. But you think about the mission statement, SWOT analysis, strategy formulation. As you go through those steps, you're probably going to think about, wow, well, in order to achieve these things, in order to capitalize or make the most out of circumstances involving strengths, weaknesses, opportunities, and threats, in order to achieve the goals, and our strategy formulation, if you remember from that video, we talk about getting point A to point B and how strategy formulation creates the map, the path for you. There might be large-scale projects involved in doing any of those things. Okay, excuse me. Probably as you've gone through those steps, things have come to mind. And, again, capital budgeting is where you hammer out the finer points and you compare, and look at the practicality of doing these sorts of things. Because if, you have a strategy, it's going to take you from where you are to where you want to be, and you have it in your head that that involves building a tower from here to the heavens, and that sounds sarcastic, it's not meant to be, but it's like an extreme example, okay? That you might find that prohibitive once you actually put numbers into a spreadsheet, once you actually run the calculations, okay? Just like I said, that's an extreme example, but to illustrate a point that what you think, it's fine to think we want to do as a church XYZ to get from where we are to our goal, but like I said, you've got to ultimately it's ultimately about the numbers, because it will cost something, like I said. So anyhow, no dream's too big. It doesn't hurt to plug it in. You can make tweaks to your dream from there once you get the feedback from the capital budgeting, and jot them all down. Every project that you can conceive of that ties into your mission, your SWOT analysis, and your strategy formulation, and just be prepared to do some thinking and some forecasting. So in this instance, we're not building in this example, I should say, of my spreadsheet here, my example spreadsheet, we are not building a tower to the heavens, something a little more modest than that, simply adding on to the parking lot of the church, okay? So, in this hypothetical example, the church has noticed that membership is outgrowing the existing parking resources. They've got, more members coming in, which is good, but they've got them parking out on the street. They got them parking across the busy street, crossing with no crosswalk. They've got them parking all up and down a residential neighborhood. It's, creating a little tension with the neighbors there, and it's time to consider adding onto the parking lot, to to not only accommodate new members, but to make room for, the future where hopefully membership will continue to grow. So the project specifically is about taking some of their undeveloped land. I'm going to assume they already got the land there. They got a big lot, and they just want to add an additional 52 parking spaces. So the first thing we'll make note of, now I also have a general capital budget video that accompanies my general workbook. Okay, now what I've done here is I've got my generic, we'll call them workbooks, a lot of them, 10 right now, another 12 or so that I have planned right now to go. These are generic, like for instance, the capital budgeting one, or a lot of it, the operating budget, revolves around a manufacturing company. Now, a manufacturing company is quite a bit different from a church. So I've got the general one that kind of allows an individual to download the workbook and to toy around with it and to just kind of wrap their mind around the concepts in it, and then obviously an accompanying video. Okay, but in this instance, I made this capital budgeting worksheet specifically for churches. Okay, so it's different. All right. So if you watch my generic capital budgeting video, you'll notice that the first thing we start with is talking about the old asset. Okay. So we look here, you'll notice that there's quite a few of those fields missing, and it's all mostly about the new asset. The current market value of the old asset is the only thing we're interested in terms of the old asset. So why is that? The old asset is considered in the generic capital budgeting worksheet in large part because of the effects of a gain or loss from selling the old asset. Okay, so the current market compared to the book value of the old asset. In this case, with a church, since churches have the benefit of zero income taxes, none of that matters. They'll still file financial statements according to generally accepted accounting principles, so they'll still record depreciation, but since depreciation has no effect on taxes because there are no taxes, we don't include it here. It would just clutter things up, make it even more confusing, and confusion is something that I'm trying to avoid, so it's left off. And it's also, let me make note, that's part of the reason I made these videos, is because I know this is not everybody's cup of tea, and if you're a pastor in a church or someone else in a leadership role there, you might be like, my business is running a church and fulfilling our mission, and this is all too much for me. Fair enough. But I really do strive in my videos, particularly the ones on the spreadsheets, to simplify things as much as I can. So I hope that between the video and the post, you can come back and watch the video again. You'll have the shortcuts, like I said, down in the description. There's a post. You can come back to it again and again. I mean, hopefully between the two, these concepts will be explained thoroughly enough that you can grasp it. I mean, I imagine most of you watching have somebody doing your books, maybe in-house, probably a CPA, doing taxes or that, and then I'm sure a very competent individual. But if you go to them and ask for them to do capital budgeting for 5 projects you're looking at, I don't know what response you're going to get. It might be, yeah, no problem, or it might be, I'm not familiar with that. So this is why I make these videos. So, since you're the one watching it. You're probably the one responsible for the total well-being of your church. That, I don't expect to be an expert. I mean, I'm the expert. That's why I made the formulas. That, all you should have to do is hopefully kind of understand the concepts and fill in the blanks, basically. It's just like a piece of software. You enter figures, it spits out an output, okay? So don't let none of this freak you out, okay? So, like I said, when it comes to capital budgeting here, we got rid of some of the extra fields that we didn't need specifically for churches. So the only thing we need to know about the old asset, like I said, is the current market value, because that will be cash in. This is what you can sell it for. You'll enter that right there, of course. Now, this is a parking lot. This project is adding to our existing parking, so there's nothing to dispose of, okay? I mean, I guess in theory you could sell the fill dirt, but that's starting to get a little too mired into details. So it's just something new being created. Nothing old's really being dealt with here. But if you were able to sell something, an old piece of equipment, landscaping equipment, an organ, then you would enter what you could sell it for here. Okay. This is also a good time to touch on real quick sunk costs. And, before we get too much further into this, talking about this capital budget, like I said, I want to touch on this subject just briefly because it's tough to wrap your head around as a human being. It's tough for me. I know darn well what it is. Most people, accounting professionals, do, at least in conceptually, but it's hard to act upon emotionally as a human being. A sunk cost. And what is a sunk cost? It is a cost that's already been incurred and shouldn't have any bearing on future decision making. So what that means is basically cash that's spent in the past has no bearing on the future. And want to touch on this, like I said, before we get too far into it, because let's just say you've got, like I said, an old asset that you spent $1 million on. I'll use an extreme example, okay? And it's 3 years later, and this old asset just sits there now, and you can only sell it in the market for $10,000. Okay, its value's gone down that much, from $1 million to $10,000. $1 million 3 years ago to $10,000 today. You're going to be tempted, because you're human, we all are, to be like, I just want to get use out of that, because we spent so much on it. It'd be such a waste to sell it for $10,000. You'd be hung up on the fact that, it would feel like a loss, but again, if what you're going to replace it with had a positive value and was your best bet in terms of projects, then it would be in your best interest to just sell it for the $10,000, because that $1 million that you bought it for is already spent. It's gone. It's in the past. It's sunk. Okay, hence the name, sunk cost. So you can't get hung up on that, all right? Or at least not. You can't be making decisions ultimately on that, because on sunk costs, because they're gone, they're done, the money's spent, it's gone, it's the past, it has no bearing on future decisions. So I bring that up here because, in the course of capital budgeting, you're going to be thinking about replacing the old with the new, and it just runs the risk of having situations where you see something quantitatively in the results of this capital budgeting, but inside here you're like, man, I don't want to do that because it'll just feel, because it seems wrong, because I spent, we as a church spent, this much in the past, and you just got to trust the numbers, and you always got to qualify the numbers, but you just can't get hung up on money that's spent in the past because it's gone. It has no bearing on what happens in the future. So keep that in mind going forward here. So, okay. So with that, we'll move on. The initial cash outlay. Okay. The cost of the new asset. All right. So in this case, I did a little homework and approximated the cost of a 53 stall parking lot addition at $208,000. Okay. So what we want to keep in mind here when we're talking about the cost of the new asset is it's not just here's what the paving company quoted. Okay, you want to take into account every cost. Okay, so it's a new parking lot. What might that be? Well, the design of it, any surveying you might need done, hooking up, drainage to the city's sewer systems, permits, okay, like I said, like a civil engineer or whatever type of engineer it would be. All those things, not just flat out, the church down the street or the restaurant down the street added 53 spots and it cost $150,000, and that's what it'll cost us, You want to think through the entire process from start to finish, and specifically what those cash outlays are going to be. You want to include everything because it'll skew results. If not, it'll make the initial payment seem too low and will make the project appear more appealing than it should. Okay. So we think about all those costs now, and that the information should be relatively easy to gather or to estimate. But here's where it gets a little tough. When I'm thinking of the future, the salvage value of the new asset. Okay, and this is what you expect it will be worth at the end of its useful life, which is what we estimate in the next section. Probably could have switched these two, useful life first, then salvage value. But while we're on the concept of costs, okay, it's this is far into the future, and it might seem crazy to even think about it. 15 years. Who the heck knows, right? How much something will be worth. But when we're talking projects, we're talking higher cost. I popped the button there. This shirt likes to pop buttons open. Pardon me. We're talking about high cost projects here, high cost assets. Okay, so the salvage value, though it might be a small percentage of what we paid to begin with, can still be a significant chunk of money. So it merits thinking about. And then maybe it won't be the asset itself, but maybe it's like the scrap value, okay, at the end of its useful life. Again, tough to estimate, but give it some thought as to what this new asset will be worth at the end of its useful life. What cash you can get out of it, okay? Not what you hope it'll be worth, but what cash you think you might be able to get out of it. A little trick here when making any sort of estimate, okay, because there's a lot of estimating, a lot of forecasting here in capital budgeting, but don't let that scare you off, okay? The revenue and the costs from these projects ain't going to be zero, okay? So if you make a guess that's even a wild guess, it's probably going to be more accurate than just assuming it's going to be zero and disregarding it. Okay, so don't sell yourself short. You might not be a fortune teller, but that doesn't mean that you shouldn't try to forecast these things because they matter, and it's okay to be wrong. So when it comes to salvage value here or anything else you're forecasting, just you're like, I have no idea where to begin. Fair enough. Okay, start with a number that's insanely high. Okay, the salvage value, like, there's no way we'd get this for it. Then start with a value that's absurdly low. Okay, might be 0, might be, another absurdly low number. So, and then just kind of work your way from each side. Like that's, hence the term, narrow it down from there. Then you think, well, okay, this is a pretty reasonable range. All right. I would, use your judgment, but then I would still err on the side of being conservative. Okay, on the low side. Just, the more conservative you are when you run these type of analyses, just the better the likelihood that you're going to come out the other end, feeling good about that the better the likelihood of you making a safe decision. So, like I said, that's just kind of a little rule of thumb trick to try. You can do the average of the two numbers once you get to the range, or like I said, just as a rule of thumb, I would suggest you be a little more conservative than liberal or loose with the numbers. Okay, so in this case, in our example, it's a parking lot. Okay, so it has no salvage value. I mean, potentially, I entered 0, obviously, an example. Potentially, it could be, I don't know if anybody buys that stuff or they just take the scrap to make shingles out of or something like that. Or if that's tires, I'm thinking they're asphalt shingles. So, anyhow, we're just assuming 0. Super conservative, and that's what I put in there. So I want to think then about the new asset's life, okay? And this will depend in large part on the amount of maintenance you put into it, particularly in a parking lot. I was kind of surprised as I was researching this to find out the amount of maintenance that parking lots required. Like you'll notice that if you've watched the generic capital budgeting video that, and I'll put a link of that down in the description too, so you can just get a little different perspective there. But you'll hear a lot of the same things repeated. That we have depreciable life and useful life, and in the church example here of capital budgeting, we only have useful life because, again, depreciation doesn't factor in since there are no taxes to be paid. So, this is another guess. Use the little rule of thumb trick I mentioned earlier if you need to. And, err on the conservative side. In the example here, we used 15 years. Do keep in mind, though, that a longer life is going to inflate the potential value of a project. Everything else being equal, an asset that lasts 10 years is worth more than one that lasts 5 years. An asset that lasts 15 years is worth more than one that lasts 10. Okay? More cash flow. Again, as a rule of thumb, all things being equal. Particularly if it, provides a benefit and doesn't just have costs. So, like I said, I did a little searching on the internet, and the expected life of a parking lot is 10 to 15 years. And decided, since this is a church and this would be for a nonprofit organization, that they would do everything in their effort to maintain it and have that parking lot last as long as possible. It'd be in their best interest, even if maintenance is expensive. The avoidance of having to pay for a brand new one would still help them come out ahead, even though the maintenance is expensive. Excuse me. All right, so the last variable up here at top is the hurdle rate. Okay, so Time, money, everything is limited. Okay, it's not unlimited. So you can't just take on every single project you want to. All right. So in order for a project to make sense, you have to get a certain rate of return on your money. Now again, I can't emphasize enough. Return for a church might be something that transcends just dollars and cents. I get that. This is why I say you have to quantify it, though. It still has to transcend it enough. If your church had a project of, that cost $1 million, and it set out to, help prevent the impoverished among us from getting ingrown toenails. Ingrown toenails are nasty, but it might not be worth it. The benefit, it would be good, would help people certainly, but this goes back. That's why it needs to be quantified. Okay. I mean, I suppose if it helped everybody in the world avoid an ingrown toenail, and maybe, but you get what I'm saying. So anyhow, so hurdle rate. Okay. This is kind of the return on what you're spending, okay, or the amount you need to clear, the return that you need to clear in order for a project to make sense. So another example is, say you had $1,000 and had the opportunity to invest it and get $1,050 in 10 years. Would you take that opportunity, air quotes, or would you pass on it? You would probably pass, okay, because that's 5% total over 10 years, or 0.5% per year, and that's just not a good return. Okay, so again, that's why we make a hurdle rate. So in that example, you knew the return you were going to get, that hypothetical example, but you might not know until you put in the revenue or the benefits, the cost savings, the additional, all those things, and just at first glance, looking at those amounts over the next 5, 10, 15, 20, 25 years. But this is where you say, and all that'll be calculated for you, but where you say, yeah, we're as an organization not interested in projects that don't meet this hurdle rate. Okay. And again, maybe you don't know what a hurdle rate is right offhand. Your hurdle rate. Okay. Same exercise. You probably don't have to start at 0 though with your low end of a hurdle rate, because think about, if your church particularly borrows money, what percentage rate do you borrow it at? You want to earn a return above and beyond what you borrow at, because then that allows your church to, if you do use leverage, borrow money, then to gain a benefit from that. So it's same sort of thing, same exercise. Start with a low end, like an absurdly low and absurdly high. Work your way from each direction, and then take an average and take a conservative, sway towards the conservative side, lower side of that, whatever. But ultimately, this is something that's necessary to do a capital budget. Okay. So, because every increase then the higher your hurdle rate, the more pressure the projects you review are going to be under to be high performing. Okay, they'll have to be to clear that hurdle. So, there's also a rule of thumb. Now, each project can have a different hurdle rate, and the rule of thumb there is, the riskier the project, the higher the hurdle rate should be. Okay, more risk, you can expect a higher return. So factor that into your consideration too. Now, parking lot in our example here is not a terribly risky project as far as projects go. Really the risk is that you bring in enough new members to justify it, and that membership doesn't begin to decline, after you've already done a new parking lot. So in this instance, I went with 8.8%, just as, a little cushion there. I thought 8 was pretty reasonable. 8.8 was a 10% jump. Put a little more pressure on the project to make sense. So, all right, so we move on here. All that sets the stage for the project, but this is the meat and potatoes, okay? The additional cost, the additional revenue or benefit, the additional cost savings, okay, which is the same as revenue in essence, because dollar saves a dollar earned, right? And these have to do with cash predominantly. Particularly costs will be cash. Cost savings will be cash. It's only the revenue, like I said, that you can maybe exercise a little discretion and use hypothetical dollars due to the good that a project might do. But don't do that too liberally, because you'll just overinflate the value of projects, okay? So cash outflows, particularly up front, it's going to be an outflow right here, the $208,000, just to start the project, just to kick it off, okay? But most projects are going to also take costs going forward, year after year, month after month, week after week, maybe. So again, you want to think this part through thoroughly. You want to think about the amounts. You want to think about the timing, okay? So in light of that, this is something that's not on the generic worksheet. I created this future cash flow worksheet. Now, it's not super detailed as to be overwhelming, not by week, not by month, or that, it's by year, okay? But it allows you to enter your additional costs that you forecast as a negative amount. And this doesn't carry over to here, the data entry worksheet. Okay, this is, you can toy around in this. And again, white cells are adjustable, so if they're white, feel free to change them. The colored cells are going to be text or formulas, so unless you really know what you're doing, don't change those, because then you kind of throw a wrench in the whole workbook. All right. So you see what I did here as an example. These amounts do match, but it's like you can come to this future cash flow worksheet first and kind of just start putting figures in, kind of start getting an idea. So, put in, I kind of separated them out here, but, and just there's a section for comments over here about everything you entered. So, like we've got 450, 459, and see, I do have a formula in there, but that's just for my own benefit. You could, if you download this, you can erase it. Because I kind of expected snow removal, okay? Where I'm at, we have hot summers and cold winters and, a very unpredictable amount of precipitation, but we get snow often enough. So, if the church if it starts snowing Saturday and, 6 inches, 8 inches or whatever, better have plans made for somebody to come clear that parking lot out on Sunday, or, turnout at church is going to be that much worse. Okay, so factored that in there. Again, it's just an estimate. You don't know how much is going to snow from year to year. If you're forecasting for a parking lot, it's just an estimate. Okay, the important thing is it's been considered. Okay, and it's not an insane amount. It's a nice conservative estimate, and hopefully that snow removal is 0 every year. That's all to your benefit if it is. But you can see here, so I did it for cost. did it for revenue. Talked about the additional member contributions, kind of starting year one, and at a third capacity of the parking lot, working up to 100%. So it just kind of bumped it up year after year. Here, made estimates of additional revenue, taking into consideration, inflation. As inflation goes up, $1 worth less, people would theoretically donate more. Members would donate more. Things of that sort. So it's really just an area to play around in. Okay, I mean, again, as long as you don't, nothing you do here is going to carry over to any of the other worksheets, particularly the most important part, the end formula is there. But, like I said, especially if you stay in just the white cells and make your notes and everything, and, about revenue, about cost savings, etc., and say, okay, I feel good about year one, let's move to year two. Do year two, feel good about that. 3, go through, revise, etc. You're, giving it enough thought, you're going to have a pretty good basis then to plug data in here on the data entry sheet. Okay, and that's exactly what I did. Okay, so these amounts should tie into like 49,716 there last year, additional revenue. Should plug in here. Okay, so put in a couple comments here. There's room for that too on the data entry worksheet, but basically use this as kind of a a blank slate that will do the addition for you, and came up with some numbers that was satisfied with, so I plugged them in here. So that's it on the data entry worksheet. Okay. A little bit about cost savings. Now, additional revenue, you probably understand. Again, I've said it a couple times. I'll say it again a couple times. Revenue might transcend dollars and cents. So again, just use your best judgment there. That's such a wide open topic, on how to value the good that a church might do. I mean, again, a human life is priceless for all intents and purposes. But, you ultimately have to come up with a figure. Okay, can be a little uncomfortable, but when you're the man or woman in charge, and then that's something you signed up to do. So use your own discretion there. I'm not even really going to get into it, but let's talk about additional cost savings real quick before we move on to the summary. Okay, again, take a lot of consideration. Now, cost savings, well, what could that involve? Things like lower utility bills, potentially like automation, like if you bought a piece of software that lessens the need for staff, something new you bought that requires less maintenance or insurance. Maybe since the new project will make enough revenue that you won't have to borrow, the cost savings will be in the form of interest saved that you would spend on money you'd otherwise borrow. See, so it's kind of like a, and that's getting like, whoa, that's a lot to think of, but like second, third order effects there. So, don't beat yourself up. You don't think of something. It's not, here's the thing about forecasts. If anybody was always right on forecast, I mean, they'd rule the world because, whether it's the stock market, whether it's betting on sports, whether it's the weather, whatever, if anybody could really forecast with 100% accuracy, they'd have the world at their fingertips. So, don't beat yourself up for not being 100% accurate, for not thinking of everything. Showing up is half the battle. Giving things a little bit of thought is 80% of the battle, I say. So just give them a little bit of thought, This thing isn't set in stone either. You don't enter the figures one time and then, oh, you're locked in. No. Go through this capital budgeting step. Move on to project 2, 3, 4, 5 from project 1. Say, oh man, we thought about this on project 5 that we should have put in project 1. Circle right around back to it. Do it. Work through all your projects. Okay. Until that money's spent, you can still make changes. That you wake up in the middle of the night, oh my gosh, we forgot about this as a revenue source, or we forgot about that as an additional cost, and go back and fix it. That's the beauty of these spreadsheets. They don't care. You can change the number every second between now and eternity, and it'll just keep, you change that input, it'll just keep spitting out new output. Okay, that's what the spreadsheet's for. That's what it exists for. That's the benefit it provides you. Okay, that's the beauty of it. So, a quick as an example for these project savings. Let's see what for the cost savings, in this case, I estimated it to be about 15,000 square feet for that 53 spot parking lot. And if it's a parking lot, sure, it requires maintenance, and that's going to cost money. But what isn't going to require? Landscaping anymore. Nobody needs to mow it. Maybe nobody needs to, put down fertilizer. Nobody needs to pick weeds. Nobody needs to, if it butts up against the building, to redo the mulch, trim the shrubs. You know what I'm saying? So, granted, the cost savings will probably be trumped by the additional cost. But don't not take them into consideration because of that, because, again, that money that doesn't come out of your pocket is just as good as a dollar that does come in, okay? The result's the same. It's the same as a dollar of additional revenue, all right? So don't shortchange the additional cost savings, okay? So I've talked quite a bit about proxies for revenue, or again, substitutions, or that, and this is just where churches have it a little bit tougher than a for-profit world. You guys don't have to pay taxes, good, but when it comes to this sort of stuff, you gotta think through it a little bit more. Like I said, I think I've covered that pretty in depth. Just be prepared to assign a number to, to the benefits received. So there's no really right or wrong answer. Yeah, that's right. In my post here, I had one little rule of thumb or trick that I came up with. And feel free to use it. Feel free not to. Whatever works for you is obviously great. So okay. So you're thinking about the benefits that might be recognized from a particular project, but you're like, man, how do I assign a dollar value to this? That's again, it's a little cringeworthy. Think about what you would pay as a church to snap your fingers and have the project done. Okay. So, like, say you had some years-long outreach program planned. What would you pay right now, today, to have it done? Snap your fingers, and the things you hope to achieve are finished. Okay? So what would you pay in year 1 to see those benefits that you expect to realize the first year done? What would you pay in year 2 to see those benefits done? Okay, that's just kind of a starting point to what the value might be. Okay, so that doesn't make it a ton easier, but it's just kind of a thought exercise to go through to perhaps, to help you arrive at a value. Because again, you just can't, I've said it several times and stand by it, you just can't really analyze these projects if you don't assign them a value. It's just the nature of capital budgeting. It's all guesswork. It's all qualifiable. If that might not be the right phrase, but if you don't do it. So anyhow, we'll move on here. That's pretty much it in terms of the inputs. And like I said, in the case of my example, it was mostly looked at the additional revenue through the lens of increased membership, increased donations. Okay, and again, the plenty of extra capacity now with the extra parking lot. We're assuming the capacity inside's okay, and we're going to say starts out at a third, and it just keeps building from there of the new parking lot. So plenty of room to grow well into the future. Okay, so that's it as far as the inputs go. Let's look at the outputs here. And again, I narrowed these down a little bit for simplicity's sake from the generic capital budgeting worksheet. So this is where I'm going to warn you ahead of time. There's going to be a little more business talk here, but bear with me. I'll try to talk through everything. Again, the post. Okay, go to the post, read. I get it in depth, and if I don't, I certainly hope to, but if I don't cover it, a term in depth enough for you to wrap your head around, and by all means, there'll be plenty of resources elsewhere. I didn't just conceive the term net present value, NPV. That isn't something I made up. It's been very thoroughly covered by academics and people who, like myself, who seek to educate other people on it. So plenty of resources out there. Okay, so we will start with the first one, net present value. All right. This is one of the more important of the four metrics, okay? And at first glance, what you're looking for here is for it to be positive, okay? So net present value, in a nutshell, without going through the mathematics involved, is the value of the project today. And that has to do with all the information entered on the data entry worksheet. Okay, all this information up here, especially all this information about additional costs, revenue, cost savings, particularly this net cash flow year after year. Okay, cash in, cash out. You've heard me say that. That's what's going to affect this net present value. So all that culminates in this figure here, and it basically, this is what the project's worth today. Okay, so building a parking lot is, for all intents and purposes, the same as putting in your pocket $65,000, $65,173 right now. Conceptually, it's the same. That's what it's worth. Okay, so it's positive. So it's worthwhile. It's worth taking on. Okay, and all of this. The reason that it's positive has to do with the time value of money. All right, and the time value of money is a concept I think most people kind of intuitively know, but maybe not in detail. And what that means is that a dollar today is worth more than a dollar tomorrow. $100 today is worth more than $100 a year from now. Why? Because with that $100, you could invest it, earn a return. You could spend it on something, a salary for somebody in the church, and earn a return in essence. Okay, somebody provide value for that salary. You could buy, not practically, but you could buy a tiny little chunk of parking lot, or a piece of contribute it to the parking lot fund. Let's put it that way. It would add value in that respect. So that's why cash today is worth more than cash tomorrow. The least of which reasons is because of inflation. Okay, $100 today will only have the buying power of $98 a year from now, whatever it may be. So the time value of money factors into all of these outputs. Okay. And that has to do, also ties in with, how far into the future it is and this hurdle rate. Again, I won't get too much into the math, but that the post goes in a little more detail on that. So, okay. So, you want a project with the highest net present value, right? Well, in theory, yeah. All things being equal, you'll hear me use that term a lot, and not just in this video, but yes. Because again, that's what the project's worth today, all right? If building a not a 53 spot, but a 106 spot parking lot was worth $120,000 NPV, then that would be the better choice based off of your forecast. Okay, it all comes back to those forecasts, and that's why they warrant so much thought. So again, in a vacuum, yes, higher NPV is better, but we'll touch on the kind of qualifier to that here in a second. Internal rate of return is, for all intents and purposes, a different way to look at the same concept as NPV, IRR, internal rate of return. Basically, this is the hurdle rate that would make the project worth zero. If your project, it would make your project's NPV zero. Let me rephrase that. If your project is positive, then your internal rate of return is going to be higher than your hurdle rate. Okay, I always do an example here. It's 12.8%, and it's probably not exactly that because it's rounded. But if we do that, if that's the new hurdle rate, this is the rate of return you have to earn on your projects. Remember, hurdle rate, the rate you have to clear, took the NPV down to basically zero. Okay, so that just goes to show, yes, I didn't just make that up. That is the hurdle rate that would make the NPV zero. So really, you can look at the IRR as the rate of return you're earning on this project. Okay? Higher is better. All right? Higher NPV. Let's look, for instance, here. Like, say, additional revenue in year one for some reason was $100,000. Don't know why that would be with a new parking lot, but it's just an example. IRR went up from 12.8 to 20%. Better return because it earned more money. NPV went up. Okay, net present value is more because the cash inflows are higher. Okay, so that's how, just a little example, how all those things affect those outputs. Okay, so like I said, internal rate of return is basically the return that you're expecting on the project. So again, download, and I need to add the link to download in to the post, and I need to actually split the post up into two posts because it's a long one. It's 5,800 words more or less, so it's a beast. So I will do that shortly after I post this video. By the time you watch this, it'll be done, unless you're, I'm not exactly crashing Google's servers with my views on my videos as of yet, but, I keep plugging along, having faith that I'm providing value, so, anyhow, unless you're really, if you do watch this before I change the post, then you're my best customer, okay? And you don't even have to pay anything. So we'll move on. The next piece of output here is payback period. Payback period is the amount of time that it takes for your church to earn that initial investment back. So the initial investment for our parking lot was $208,000, big chunk of money. Okay, and every year we have additional cost, additional revenue, additional cost savings, and a net amount, which is the sum of those. Okay, but year one it's $14,000. It's a tiny chunk of that initial cost of $208,000. Okay, these are long-term projects, right? You ain't gonna earn your money back next month, next year probably. These are, you have to have on your long-term thinking cap when it comes to this. But eventually, if the project does what it's supposed to and is a profitable project, you will earn your money back. So, like I said, it's pretty straightforward. It gives you even a fractional year there. 7 years, 0.29. 0.29 is, whatever, roughly a third. So 7 years and 3 months and 2 weeks or something, I'm just guessing that. But that's when you would expect to earn that initial investment back. And of course, why is that significant? Once you earn that initial investment back, well, the worst you can do is break even. From there, it's all simplistically, we won't get into the details there, but for the most part, it's all profit from there. So the sooner the better. Okay. I don't put too much weight on this particular formula, this particular metric, because of its simplicity. Okay, the NPV, takes into account that time value of money. The internal rate of return does too, and so does the profitability index. The payback period doesn't, and it's really just kind of just another point to consider, maybe a tiebreaker. I guess if all other things were equal, if you felt you had two projects that were just more or less identical, you might refer to the payback period to make a decision, because you're like, well, okay, but comparing these two projects, this one gets us our money back this much sooner, so there's theoretically less risk. Conceivably that could be the case, but again, it's just more for just something to keep in mind. Kind of a background metric, if you will. So we move on to the last one, the profitability index. Okay, so this is my personal favorite in terms of the metrics from capital budgeting. And the reason it's my favorite is because it takes into account that initial investment. So again, to use extreme examples, say we had two projects, okay? So one project that cost $10,000 and had a net present value of $10,000, okay? Another project that cost $1 million and had a net present value of $10,000. Well, if you're just judging by net present value, they're both equal. Do either project. Doesn't matter. But probably just by listening to that obviously, barring something really exceptional, the preferable project is the $10,000, the one that costs $10,000, okay? Because it's earning 100% return. Whereas $1 million earning a tiny little fraction, whatever it is, 1% return. Okay, so it's the profitability index does that, takes into account not just the net present value, but what you're spending to get that net present value. Okay, the initial investment. So, that's why I prefer it, because it's like, what's the NPV? Okay, it's positive, it's high, okay, good, but it's what do we have to spend to get that NPV? That's important to me. So I would, typically this would be the first thing I look at. Then the net present value / internal rate of return in terms of the metrics, to judge different projects, to compare different projects. So anyhow, you can see obviously here we have all of our figures for the church parking lot, and everything looks pretty good. The NPV is a nice positive amount, $65,000. That's nothing to sneeze at, particularly for this small church example that I'm using here. Payback period's a little long, about half of the total project's life, but palatable. Internal rate of return, of course, is above our hurdle rate by about 50%, but profitability index, it's hard to say, well, this is good or bad, but it's 31% in essence, 1.31, and you don't have any other projects to compare it to, but that kind of makes it like, well, what does that mean? Is that good, bad? I mean, it serves as a comparison tool between different projects. If you're just doing, it's a good point to make. If you're just doing one project, then, is the NPV positive and this is your only option in terms of projects? Well, then go ahead and do it, If you're comparing projects, then that's where the profitability index would come into play, so you can, like I said, compare which one's preferable, which ones are preferable, might be plural. So anyhow, that kind of wraps up all the output. I know I'm long on time, an hour 20 or that. That's, I guess I'll start to wrap things up here a little bit with, first of all, there's a graph down below here, and this is the same more or less as with the generic capital budgeting workbook, and it basically just plots out cash inflows and outflows. You can see the big outflow to begin with, and then net inflows are small, growing gradually and everything. So just kind of visualizes everything entered here on the data entry worksheet. Pretty self-explanatory, really. So, I talked a little bit earlier, I guess, touch on this too, that if you have a lot of viable projects to consider, then that's good. A lot of opportunities better than no opportunity. Okay, but it can be overwhelming. Not to mention, it takes a little time to enter all those projects and the estimated cash flows and everything. So I can't tell you exactly, which projects to choose. I think, especially, again, the biggest benefit is just going through this thought process, thinking about what the future holds potentially, what pitfalls you might run into, the upside, the downside, those sorts of things. So, but I would, if it were me, and if you've watched any of my previous videos in terms of the soft skills, the mission statement, SWOT analysis, and strategy formulation, I don't pertain to give advice that I don't think I would take myself if I were in your shoes. And comparing multiple projects, again, the first thing I would do is compare the profitability indexes, and after that, kind of the NPV, IRR with the payback period as the tiebreaker. Other people, if you're not the sole decision maker in your church, you might have other people that would view things differently. To me, part of the benefit of doing things like this is that the numbers don't lie. It's not as subjective as just, talking out different projects, and this sounds good, I think this one sounds better than this one. No, I mean, this is, you put thought into it, you put numbers in, and it's quantifiable, where one project versus another should stand out, but ultimately, if you run into kind of a situation where heads are butting over what projects to pursue or that, the only advice I can really offer there is, to kind of put it up to a ranking system. It might be a situation where ultimately somebody has to make the call. That's the case sometimes, but have the other decision makers rank the projects 1 to 10, and average out the rankings. That might help kind of separate the ones you really want to pursue versus the ones that for the most part the church could live without. And like I said, if you go through these steps, the capital budgeting for each one of them, the projects, you're going to have hard data to fall back on. So yeah, I've been going on for quite a while. I told you that's what I do. I did not lie. So let me wrap it up with two things I always wrap it up with. First and foremost, if you stuck with me this long, thank you. I would assume that you have had some interest in what I've had to say. Again, I'm thankful for that. And, look, the thing is, whether it's websites or whether it's YouTube videos, it's an algorithm. Okay, they depend on feedback from the people who consume the information to decide, how often to show it, where to show it, etc. It's a popularity contest for better or worse. So if you could, I would very much appreciate a like and or subscription and or alert and or comments. I'll touch on comments again here in a second. Just, it's absolutely free. It's just a click of the mouse, sends a signal to YouTube that, hey, man, this guy put a lot of time and effort and a lot of thought in delivering this information, and it was valuable. And even if it just kind of helped you, it might really help the next person. So, again, it makes me uncomfortable to ask for these sorts of things. It's not really in my nature, but, I would like for this video to hit 10 likes and, 10 subscriptions if I'm not there yet. If I am there when you're watching this video, well, just feel free to pile on. But yeah, so I'm new, trying to get this thing off the ground. If you could help me out in that respect, I would be very appreciative. So speaking of comments, though, I'll give the same kind of two suggestions there, as far as what I would like to hear back from you guys regarding in terms of capital projects for your church, and give me some examples. Maybe you're part of church management. You guys have undertaken capital projects in the past, and you can say, hey, here's what we've done. Or maybe you're just a member of a church looking to get involved more and stumble upon this video and just think, here's a capital project I would like to see my church pursue. That's fine. Just, the more kind of ideas or the more situations where you can say where this type of analysis would be applicable, the more it just helps people identify with it. Okay, so the second thing is in terms of a hurdle rate. Okay, what do you think a good hurdle rate is for a church? Again, it's not a for-profit enterprise, so it doesn't need to be excessive. Probably, 25%, 30% or something like that. On the flip side, churches do borrow money, and borrowing money costs money, so it needs to at least be enough to cover the cost of capital, so to speak. So, what do you think a good rate would be? And one last question just popped into my head too, and that was something I would definitely be interested in hearing you guys' input on, is what rule of thumb would you come up with, or what system would you use to put a value on the non-financial revenue, the upside of projects? Again, the things that are tough to quantify, the good that can be done from a church project that doesn't necessarily have a dollar value. How would you go about assigning a value to that so that you could plug it into an analysis such as this? So I'd be really appreciative to hear what you guys had to say in that respect. And I'm going to wrap it up. It's been a long one. And thank you for sticking with me this long. Appreciate you watching. Liking a subscription would be very helpful. And yeah, that's it. Have a good evening, guys. Thanks.